Good evening, everyone. Thanks for joining. Due to SMSF being highly regulated and there's a lot of compliance requirements, I'll be reading through a lot of disclaimers and everything tonight throughout the webinar. So I appreciate your understanding for that, but I do have to go through them just to make sure that everybody understands. So I'm Glenn Newbery from Suburbanite. All related parties and persons hereby deny all liability and warranty of information presented. I'm not a solicitor or an accountant or a financial advisor, and I do not hold an Australian Financial Services Licence or an AFSL. Information in this presentation is of general nature and is not meant to constitute specific financial advice. I'm relating to my personal experience with strategies that I have and are currently using, employing to further my property portfolio. As individual circumstances vary, I request that you ascertain for yourself on how and whether the information you'll receive today relates to your present circumstances. I always recommend that you seek the relevant professional advice for your personal situation before making any decisions about your super or investing. By staying for the start of this presentation, you release me from all liability and losses that may arise from your use of the ideas and strategies presented in this meeting. So that's the first of many. Thanks very much for understanding. So we'll move on. So for those of you who don't know me, my name is Glenn Newbery. I am a property investment advisor and a buyer's agent and have been a buyer's agent for 11 years. I've assisted hundreds of people to either get started in investing or continue on their investing journey. I've been a property investor myself for 27 years, and I set up my SMSF in 2012, and I've bought at least 30 properties across Australia and New Zealand for myself using lots of different strategies. I currently hold 21 investment properties, both inside and outside of self-managed super fund, continually educating myself, and I'm a member of several property networking groups. I've been featured in newspaper articles in the Domain, featured on the now defunct TV show Today Tonight, where they did actually do a story on me regarding my self-managed super fund. Been in property magazines and also on podcasts. So so I've been in the industry a while. So who thinks you can actually purchase property in super? So I'll just pop up a quick little poll here. Let me just get that started. So you should see that on your screen. We'll just leave it up for a minute. Can you purchase property with your super? Either yes, no, or you don't know or you're not sure. So we're getting those responses coming in. Leave it up for another 10 seconds and then we'll end the poll. Alrighty. So the results are in and we've had 78% of people have said yes. And there are a couple of people who aren't sure whether you can purchase property with your super. So so that's hopefully we'll clear that up tonight. Alrighty, so let's go back. All right, so the answer is yes, you may be able to if you have a self-managed super fund. So speaking of self-managed super funds, got another quick poll. Who already has an SMSF or a self-managed super fund? So just got another little poll up there. Oh, it actually popped up two questions. Should have only been one. Anyway. So, yep, we've got a few people. So I'll leave that up for another couple of seconds. We'll end the poll. Cool. So there's a few people that have already got SMSF, and also quite a few people who don't have one as yet. And there are quite a few people that appear to be considering purchasing a property in an SMSF, and some that aren't. So yeah, a good spread of people here tonight that have got, already got an SMSF. So what is an SMSF? So it's a self-managed super fund. So the name describes it all. It's your own personal super fund that you manage yourself, right? So yeah, unlike the ones that you have industry funds where you have managers that basically look after it. In a self-managed super fund, as the name suggests, you need to manage it yourself. So yeah, so all right. So the question is, should you set up a self-managed super fund? Well, you'll need to speak to your accountant or licensed financial advisor to help you determine the answer to this question. So they'll make sure that you decide who the members of the self-managed super fund are going to be, because it can be yourself, it can be your partner, wife, whatever, but it also can be family members as well. So they will help you determine who you actually want in your super fund. Whether you have enough money in your super currently to make it worthwhile to set up a self-managed super fund. They'll make sure that it aligns with your wealth creation and investment goals. They'll make sure that it's part of your overall retirement strategy as well. And is it in line with your risk profile? Everybody has different risk profiles. Some people don't like too much risk. Some people are happy to take on risk. So they'll make sure that it aligns with your risk profile. And the same with retirement strategies. Everyone has a different retirement strategy, what they want in retirement. So they'll make sure that it aligns with what you're looking for. And they'll answer many other questions that need to be answered before you actually jump in, and they'll be, making sure the structures are set up properly. Should you transfer all the money out of your industry fund into the self-managed super fund, or should you only do a portion of that? And then there's insurances to consider as well. Typically you would have life insurance or TPD insurance inside of your industry super. You need to consider that as well. And you'll also need to involve a solicitor to set up the trust deeds and things like that. So overall, they'll help you determine if setting up a self-managed super fund is right for you. And it's really important to get that information up front before you start spending money and going down that path. So so really important to do that. All right, so an SMSF isn't for everybody. So you need to take a more active role in managing and controlling that super fund. So when you have an industry fund, you have people that manage that money for you, and they're managing where the investments go. I mean, you have an input into that as well, but they're managing all of that. So it's kind of a bit more of a passive super fund setup, whereas an SMSF is definitely more active. So that's one thing to consider. Compliance. Now, your accountant and financial advisor will assist you with meeting your responsibilities to ensure you are fully compliant. For non-compliance can be penalties for non-compliance can be really severe. You can actually lose up to 50% of your super fund or the money in your super if your SMSF is non-compliant. So really, really important to make sure it is compliant and it stays compliant. That's a really important thing. And obviously, as I said, your accountant and financial planner will help you to make sure that it stays compliant. And of course, there's setup costs and ongoing costs. So obviously, it costs money to set up the super fund, and then there's ongoing costs. A super fund is a separate entity. It needs to submit tax returns every year, just like you do in your personal name. the self-managed super fund also needs to submit tax returns, and it also needs to be audited on an annual basis. And again, your accountant and your financial advisor can assist you with all of these things. But as I said, it is a more active role in owning or having a self-managed super fund. So can you borrow money to purchase property in your SMSF? So another quick poll. Do you think you can borrow money to purchase property inside of an SMSF? Yep, cool. So I'll leave it for a couple more seconds. All right, we'll end that poll. So yes, a lot of people do think you can borrow money, and there's a couple that aren't sure. Well, the answer to that is you may be able to borrow money in your SMSF. Now, let's go back there. So in my case, I learnt from my advisor that lenders sometimes allow up to an 80% loan to value ratio. So you can borrow 80% of the value of a property that you're looking to purchase. But this varies from lender to lender, and it must be confirmed with a licensed professional. Now, quite often, the loan to value ratio can be less than 80%. So, I've heard of 65% LVRs on some SMSF loans. So that means you're going to need more capital in your super to be able to cover the deposit and the purchase costs for that property. If you're only getting, say, for example, a 65% LVR loan, you're going to need 35% deposit of the property. But there are up to 80% loans in some cases. But another thing is that the interest rates in self-managed super fund loans tend to be higher than what they are for loans outside of super. Sometimes they can be really significant. I know one of mine a little while back was 9.7, and that was only probably less than 12 months ago until I refinanced away from that lender. So they can be quite high. But these days, at the moment, the ones that I've seen, the rates are not too bad, like still in sixes. Even though the outside has dropped kind of below the 6% now. Ones that I've seen have been kind of in that 6% range, so it's not too bad. And also, there is limited recourse borrowing arrangement, or LRBA. And for those of you who don't know what that is, the lender's recourse is limited to the specific asset that is purchased through the limited recourse borrowing arrangement. So they can't claim against another SMSF asset if the loan defaults. So, that means, like, unlike outside of super, if you default on a loan, then the bank doesn't recover all of the money for the loan. They will come after other assets to recover the remaining money that's owed. In a super fund, they can't do that. They can only recover the money from the asset that was purchased using those funds. So, so that's a little bit different to what you would see outside of super. All right. Lots of rules and regulations around super, as I mentioned previously. So investments that you make in your self-managed super fund or SMSF must be in accordance with your fund's trust deed and superannuation laws. Super laws require you to prepare an investment strategy for your SMSF, which obviously your accountant financial planner will assist with, which is your plan for making, holding, and realizing assets. And it should set out why and how you've chosen the assets to meet your fund's investment objectives and members' retirement goals. So so you need to set all that out. That's all got to be set inside the trust deed for the super fund. Now, it must meet the sole purpose test. So what is the sole purpose test? Any investment in your SMSF makes any investment your SMSF makes needs to be made and maintained for the sole purpose of providing retirement benefits for the members of the self-managed super fund, or pay death benefits if a member dies before retirement. So every investment must meet that sole purpose test. It's there to provide benefits for the members in retirement. So that's one of the rules. Another one is residential property must be at arm's length. Now, again, what does arm's length mean? It means that the property that you're purchasing through the self-managed super fund cannot be acquired from a member of the self-managed super fund or any of the members' related parties. And again, what's a related party? Well, broadly, it's probably pretty much anyone that you know, right? So you're not allowed to have a relationship. So they're not allowed to be related to you. Generally speaking, you're not supposed to have a relationship with those people at all. It also means that you can't live in that property. And again, related parties can't live in that property either. So you can't go and buy a property in your self-managed super fund and, have a relative living in that property. You can't do that. And also it can't be rented by any of the members or the members' related parties. So, if you're kind of thinking, oh, I might, buy a holiday home on the Gold Coast or something and use it for holidays. No, can't do that. And also you can't buy one and then rent it out and let, relatives or anyone like that use it either. You can't do it. It must be arm's length. Basically, you're not allowed to have a relationship with anybody that lives in or rents that property. So the QR code that you see there on the screen will take you to an ATO website that will give you what the SMSF investment restrictions are. If you wanted a bit more information on that, I'll put that QR code there for you if that was of interest to you. Also, you can't access equity in an SMSF property. So the diagram I've got here on the right-hand side, outside of SMSF, if you had a property and let's say it was worth $1 million and you had a $600,000 debt left on it, that means you've got $400,000 worth of equity. Now, typically speaking, you can't access 100% of that equity. The bank would like to see, 20% of equity remaining, which means in this scenario, you wouldn't be able to touch $200,000 of that $400,000 equity, but you would have access potentially to $200,000 of that. Outside of SMSF, you could then get that $200,000 and potentially use that for a 20% deposit plus your purchase costs to buy an investment property, let's say a $500,000 property. You're going to use about $125,000 and the bank would give you the loan for the rest. Well, inside of super, you can't do that. You can't utilize equity from a property that is inside of super. And in fact, there's no way you can access the equity. Even if you refinance that loan from one lender to another, the incoming lender can only refinance the debt at the same level as the outgoing lender. So the debt is not allowed to increase at all. So you can't get access to that equity. The only way you could potentially do that would be to sell the property, would be the only way you could get access to the equity is by selling it. And then you'd have capital gains tax implications with that. Speak to your accountant before you do that. Also, as I mentioned before, compliance, lots of compliance around self-managed super funds. So So yeah, you really need to be getting the right advice from your accountant and your financial planner before you, consider whether it's right for you to set up a self-managed super fund. And before you jump in and start paying money to set it up, you need to really get good advice on all of this first. Alrighty. So what prompted me to speak to my accountant and financial advisor about setting up a self-managed super fund? So in 2012, I spoke to my accountant and financial advisor about setting up a self-managed super fund. But why? What prompted me to do that? So there was a few things. So in 2012, I kind of looked at the balance of my super fund from 2007 to 2012. And keep in mind, we did have a GFC during that period. So 2009 was the GFC. But my balance in 2012 was less than what it was in 2007. And of course, that happened to a lot of people because of the GFC. I looked at that and I went, I'm losing money, not making money. So I thought, what can I do about it? How can I have more control? So that was one of the things that prompted me. It aligned with my retirement strategy and my risk profile as well. So I had a retirement strategy and still do have a retirement strategy. I know what I want and I know exactly what I want to be able to do. It aligned with that. But I'd also exhausted all of my borrowing capacity outside of super, right? So I'd been investing at this stage for 13 years or something, 14 years. Basically, I didn't have any more borrowing capacity in my personal name. And so sometimes, not always, but sometimes your borrowing capacity inside of super is not affected by your borrowing capacity outside of super. But again, get some advice around that for your scenario. But for me, that was an opportunity to keep borrowing money because I could actually do that. I understood property. Obviously, as I said, I'd been investing in property for 14 years prior to this. I understood leverage, and I was very comfortable with property as an asset. To put in my super fund. So that prompted me as well, and it seemed to be a natural progression for me. Having bought properties outside of super, in my personal name and also in a trust as well. It just seemed to be a natural progression. But again, get that advice from your accountant and you really need to sit down and talk to them. I can't emphasize that enough. So some of the topics that I discussed with my accountant and financial planner. Now, obviously, whether these apply to you depends entirely on your circumstances, right? But these were some of the things that I discussed. So obviously having control of what I did and where my money was invested in super was a big thing. Now, yes, in industry funds, you do have some control over, what sort of asset classes you can invest in and things like that. I wanted to have a little bit more control than that. Also, a little bit of flexibility, obviously, with what and where I invested. And members, who were going to be the members of the super fund? Was it just going to be family? Was it going to be relatives? What was that going to be? What was that going to look like? So obviously had all of those discussions with the accountant and financial planner. Diversification, it allowed me to directly or could potentially allow me to directly invest in property, which in an industry fund, you can certainly invest in stocks that invest in property, but not direct property. So it allowed me to have a little bit of diversification. So we spoke about the diversification piece. Were there potential tax benefits of having a self-managed super fund and investing in super as well? So we obviously discussed that, and I'm not going to talk about the tax benefits, but speak to your accountant about the tax benefits that there might be for you if you are looking at setting up a self-managed super fund. And as I mentioned before, leverage, right? So could I take advantage of leverage, and what was, were there benefits of doing that? So again, had all of these discussions with the accountant and financial planner before I looked at setting one up. Okay, so who would be happy with this scenario? So again, disclaimer, this is for illustrative purposes only. These figures are hypothetical, don't reflect actual or expected performance. Your outcomes will depend on many factors. And again, always seek licensed advice before considering SMSF property investments. So if I had $200,000 in super in 2012, which is when I set my super fund up, and in my scenario, that is what I had. I had $200,000 in super. And if we take a purely, as I said before, illustrative example from industry data of 8.5% from Super Ratings. Now, Super Ratings is a leading superannuation research house. And according to Super Ratings, growth funds have averaged about 8.2% per annum growth over the last 10 years. And this was as of June this year. So using that example, and I just rounded it up to 8.5%, a notional 200K could look very different over a period of time. Now, this is not a forecast. It's just a mathematical example to show compounding in theory. And again, your outcomes depend entirely on licensed advice and your circumstances. But if we use that analogy, after 13 years, what would that potentially look like? And it could be around about, $577,000 from a $200,000 starting point. Now, of course, you're going to be continuing to contribute money during that period. I didn't factor that into the equation. I just said, okay, let's start with this as a base. And if we did nothing else and we just, it just compounded at 8.5% per year, what would that look like? And, that's potentially what it would look like. So who'd be happy with that scenario? Just pop it in the chat box, yes or no. Would you be happy in that scenario with that result after 13 years? Yeah, so a couple of people yes, a couple of people no. Yeah, cool. So obviously also I've got the QR code there if you wanted to see where I got that information from superratings.com.au. Then that QR code will take you to that website and you can see what their findings were with the average growth of super funds over that period. Cool. So quite a few people wouldn't be happy with that outcome. So this is what I did, right? And again, this was the right choice for me based on my circumstances, but it may not suit your circumstances. The figures don't reflect expected performance. Always discuss whether an SMSF property investment or property strategy is appropriate for you with a licensed advisor. So in 2012, as I said, I set up my super fund, and this was the first property that I purchased. So you can see here, I purchased it in October 2012 for $210,000. I then went on and purchased a second property in my super fund in February 2013 in Campbelltown. So Emerton is a suburb of Sydney, in Western Sydney, out near Mount Druitt, or St Mary's, if you know where that is. Campbelltown is southwest Sydney. If you don't know where that is, it's southwest of Sydney. And I bought that in February 2013 for $204,000, so a 2-bedroom townhouse. The first one was a 3-bedroom townhouse. And then the last one I purchased in my super fund was in Woodridge, which is a suburb of Brisbane, in October 2013 for $167,500, and that was also a 2-bedroom townhouse. Okay, so obviously, if we add all of those purchase prices up to total purchase price of $581,500, right? Now, obviously that's the purchase price, but I borrowed money to purchase those properties. So out of my super fund, the funds that I used were approximately $150,000. So that $150,000 covered 20% deposit and all of the purchase costs related to it. So things like stamp duty, legal fees, pest and building costs, all things like that were included in that. So total of about $150,000. Now I had $200,000 and I kept $50,000, which you need to do in the self-managed super fund to cover any maintenance costs or potential shortfall. If there's not enough rental income to cover the mortgage payment, you've got to have money to cover that. So I had $50,000 left over to do that. So that's how it started. Now, got another question for you. We're now, 12 or 13 years down the track from when I purchased these properties. Who'd like to have a guess at what the value of those 3 properties would be today? Pop it into the chat box. I'd be interested to see what people think those 3 properties combined might be worth in today's market 12 or 13 years later. Any guesses? Yep, 1.2 mil, 1.1, 2 mil, 2 mil. Okay, cool. 1.5, 2 mil. Yep, cool. So, all right, let's see what happened. So again, what does it look like after 13 years? So again, here's how my own SMSF property investments performed over 13 years. This was specific to my situation, and it's not a prediction or a recommendation at all. Outcomes vary widely, and licensed advice is essential before considering SMSF property. So how did this all pan out up to today, right? So here's the first property and the current estimated value as of, so I've got this information from Cotality, which is the old RP Data or CoreLogic, if you know who they are. So they're the industry standard for property research, basically. So I checked these prices all yesterday, or the estimated values yesterday. So the first one, 555,000, which I bought, I think was 204,000. The second one is now valued at 405. I think that was 210, I think. Maybe I got those two round the wrong way. And then the third one is now 450, and that was 167,500 when I bought it. So in total, today, estimated value around 1.41. So those of you who said, 1.2, 1.5, pretty close to the mark. I wish it was 2 or 2.2, but yeah, unfortunately not. So what does that mean? I've still got a remaining debt of $400,000 or $441,000 across those 3 properties. And I invested, obviously, as I said, $200,000 into that. So the total net value, obviously the 1.41 minus the 441,000, leaves me with a net value of 969,000. So basically the $200,000, the outcome is now potentially 969,000. Whereas previously when I spoke about the other type of investment at 8.5% was 577,000, I think, from memory. So quite a bit of a difference. So who'd be happy with this outcome? Or would there be anyone that's not happy with this outcome and would still want more? Yeah. So for me, obviously, past performance is not an indicator of future results, and it's not advice at all. And, in my own SMSF journey, the properties I purchased increased in value over time. And, this is my specific situation. I only show as an example of what happened for me. It's not a guide of, what you should expect. And, but the other thing to point out here is that it doesn't matter whether this was inside of super or outside of super, the result is going to be the same. The only difference is I used super money to cover the deposit and the purchase costs rather than, equity or personal cash outside of super to cover the purchase costs. It's the only difference. It's just the entity that it's held in. And obviously with all the regulation that goes around it. But I use the leverage inside of super instead of outside of super, but it doesn't mean that, that this is right for you. And if you do the same thing, you're going to get the same result, because you almost certainly won't, right? The markets are different. But I know what a lot of you are probably thinking, well, you did that 12 or 13 years ago, so that's great, but it's not going to be like that now, or it's not going to be, that may not be the case. It's a lot harder. So what I thought I would do is I thought I would actually show you a case study of a recent SMSF purchase. Again, here's an example of a recent property purchased inside my self-managed super fund. I share this only to illustrate what's possible in my experience. This is not a guarantee of results, and it may not be appropriate for your circumstances. Always consult a licensed advisor. So this property here is in a suburb of Perth called Kinross in Western Australia. And you can see, again, I prepared this information yesterday. So I purchased this property in May 2025. The purchase price was $735,000. And it's currently rented out for $720 a week, which is a 5.1% gross rental yield, which is, substantially better than what you would get, say, for example, in Sydney, which would, average rental yield in Sydney, 3 to 3.5 maybe. So substantially below 5, which means that your out-of-pocket costs are probably going to be higher, which means it's going to be draining funds from your super much faster, right? But the current estimated value today is $805,000. Now, that's 9.5% growth, or $70,000 growth in just on 5 months. It'll be 5 months next week since I've owned this property. The funds that I used for this purchase from the super fund was approximately $185,000. So that's about a 37% return on my $185,000 in 6 months time frame. So again, past performance is not indicative of future results, and this is definitely not advice. But I just want to show you, what may be possible, right? And why I chose to set up a self-managed super fund and invest. Adrian's asked me, why did you stop at only 3 properties? The reason I stopped at 3 was because just after that, in 2013 or 2014, I actually got made redundant in my job. And I totally changed careers, and that's when I became a buyer's agent in 2015. So totally new career. So I have an IT background. So I've completely changed careers. So quite often, and this got nothing to do with super, but quite often if you, even if you change jobs, as long as you're in the same industry, borrowing can be easier to get. You still may have to wait a period before you can get borrowing. But when you change industries completely, yeah, the banks kind of go, you've never done that before. Are you going to still be able to earn money kind of scenario? So I wasn't contributing into my super fund for quite a period of time. So I had to stop. But recently, as you can see, I've purchased another one and potentially looking to buy another one, literally going through the process at the moment to see whether I have borrowing capacity to purchase another one. So that might be for a future webinar. But yeah, so I just wanted to show an example of what, why I did it and what's happened for me. So when should you buy? Should you be looking now? Where should you buy? What should you buy? And how should you buy it? So I thought I'd cover this because these are questions that I get asked a lot. When should I be buying? Where should I be buying? What should I be buying? So when should you buy? Should you be buying now or should you wait? Good question. So some investors choose to buy whenever they have borrowing capacity, while others choose to wait. The timing always depends on your own financial goals and the professional advice, right? You need to get that advice. When should you be buying? Should you be buying now? I've seen scenarios where people can get borrowing. They can get borrowing. They've got borrowing capacity, but I know their financial situation is going to change. So just because you can borrow money doesn't mean you should. If your financial situation is going to change, then probably best to let that change happen and then see whether you've still got borrowing capacity. So, I've actually advised people not to be buying property, and this wasn't in super, this was outside of super. I actually advised people not to buy because I knew their financial situation was going to change. But obviously, we're in an environment at the moment, although it didn't happen this week, interest rates are decreasing. So when interest rates decrease, that obviously makes it easier for people to buy because it increases their borrowing capacity. So it makes it easier for them to buy, and people that may not have been able to borrow enough money when that interest rate goes down, increases their borrowing capacity. Now they may be able to borrow money or enough money to buy what they want. Also, I'm guessing most of you would know that we've had a first home buyer 5% deposit guarantee scheme come into play as of yesterday. And basically, without getting into too much detail with that, I don't want to go down the rabbit warren, but first home buyers can now buy a home with only a 5% deposit and not have to pay lender's mortgage insurance. Now, that has really, and been talking to a couple of brokers who've been telling me they're getting lots of inquiry about this from first home buyers. So what is that going to do? That's going to increase demand, right? So the competition to buy the same amount of stock that we already have is going to increase, right? So competition is going to increase, and that's going to make it more difficult to purchase properties. So an increased number of buyers will typically cause prices to increase, right? You've got more demand with the same amount of supply, right? So, and if prices increase, then over time, you may get priced out of that market, right? Because prices have increased and you've got a certain amount of borrowing capacity, and, you might get priced out, and now the amount of money you can borrow doesn't allow you to get into that market purely because the prices have increased. And when prices rise, rents don't always move at the same pace. And if rents don't move for a while, basically what that does is it erodes your yield, which means your holding costs will increase because you're borrowing more money for the same amount of rent, right? Because prices have increased. So you're borrowing you're borrowing more money, but you're still getting the same amount of rent. Therefore, your holding costs are likely to increase, right? So, so your cash flow will go down, right? So these are things to take into consideration before you jump into the market. So where and what should you buy? Well, this is going to depend on your goals, right? What are your goals? Why are you investing in property? What are you trying to achieve from those investments? These all factor in to determining where you should be buying and what you should be buying. What's your time frame, right? You need to consider all of these things before you just go and buy the house next door in the same street or in the same suburb, right? Because that may not be the right location to be buying. So where should you buy, right? Now, market data often shows that capital cities and regional areas perform differently in terms of growth and cash flow. How or whether this applies to you is something to confirm with your advisor. Now, for example, historically, capital cities have shown stronger long-term growth than regional locations, while regional markets sometimes provide higher rental returns than the capital cities do. Right? So these are all things you need to look at. Do you really need the capital growth or do you really need cash flow? Because that may determine whether you're buying in a capital city or in a regional location, depending on what you need from that investment, what your goal is and what it is you're trying to achieve. I like to look at suburbs where prices are trending upwards, because if the prices are trending upwards and I buy today, then hopefully, the value of my property is going to increase. And for me, that minimizes risk. It minimizes risk of losing money. While my intention might be to hold on to a property for, 10 years, and, in most scenarios, you're likely to get growth in a 10-year time frame. If I have to unexpectedly sell in a much shorter time frame, if I haven't had growth early on, then it's quite possible I might lose money. So I always want to try and buy in suburbs where prices are trending up, because that minimizes my risk of losing money, or how much money I might lose if I have to sell unexpectedly. So that's an important thing to consider. Suburbs where the properties are predominantly owner occupied. It's owner occupiers that really drive the market. Yes, investors do drive the market, but it's dangerous to purchase in an investor-driven market, because quite often those markets are volatile, right? The investors get in, they get out. So you'll see the prices tend to fluctuate a lot more in those types of areas. So focus on areas that are predominantly owner occupied, because it's a lot more stable. They don't sell properties, buy and sell. They buy it and they live in it for, a decent period of time typically. Right? So you don't get those fluctuations. Also follow the transport corridors, rail and bus routes. Obviously, people like to have transport. So they want to live in, where it's convenient to access those means of transport. And obviously infrastructure like shopping centres and hospitals and things like that are all things that you should be looking towards, when you're looking at purchasing. Near employment hubs, and again, shopping centres, hospitals, business districts and things like that. People, either want to live closer to those employment hubs, or be able to get to those employment hubs via the transport, without too much difficulty. So be looking for things like that for locations, and obviously avoid flood zones, bushfire zones, busy roads, areas that have large amounts of vacant land, because quite often large amounts of vacant land get turned into housing estates. And as I said before, that creates supply, and quite often that may stunt the growth, right? Because you only get growth when demand exceeds the supply, not when the supply exceeds the demand. Right, so that covers off where to buy. So what should we be buying? And again, this is a common observation from market data. Whether it applies to you requires licensed advice. But in my experience, residential properties have tended to show stronger growth, and commercial properties have tended to show stronger cash flow. And also, houses and townhouses and villas have tended to perform better than units. Now, this may not apply to everybody, right? So take that into consideration. Should you be buying new or established? Right. So again, I'm going to cover off that in the next slide. You know, some people prefer new, some people prefer established. So I'm going to talk about the pros and cons, I guess, of both of those, or some of the pros and cons. Buy properties that are affordable to the mass market. And this is something that I like to do. And you saw with the properties that I showed previously, especially the ones that I bought early on, very affordable back then. Of course, the prices have gone up. And probably even when you look at the prices now, would be considered very affordable, right? So if you're buying properties that are affordable to the mass market, that potentially means, not always, but potentially means more people can afford to buy those properties. So there may be more demand because more people can afford it. The more people can afford it, potentially the more demand there is. The more demand there is for that product, maybe the faster the prices will grow, right? Now, if it's affordable to buy, it may also be affordable to rent. The more people that can afford to rent it, potentially the higher the rental return might be, because you'll get, again, higher demand for that. The more demand there is will potentially push those rents up, right? So again, that's something that I've always looked at in investing. And again, I'm not talking about super in particular. Inside and outside of super, these are things that I look for personally. An asset that's going to move you towards your end goal, right? You need to understand your end goal. And if a property is not moving you towards that end goal, you shouldn't buy it, right? It needs to be moving you towards that end goal. You know, that's why we're doing it. We're moving it to achieve that end goal. And if it's not going to do that, you shouldn't be buying it. Cool. So new and established, I'll just go through these pretty quickly because I know time's getting on a bit. So new properties, and this is just general, you know, greater tax depreciation and tax benefits. Established properties, you get less depreciation benefits from those, right? Less perceived maintenance costs in something new, and potentially higher maintenance costs because it's older, things might break or need to be replaced. So might cost you a bit more for an established property. Higher purchase price. So if you had two properties, an older one and a new one in the same suburb, you're probably going to be paying a higher price for the newer product than you are for the older product, which means your mortgage costs are likely to be higher because you've got to borrow more money to buy the higher value property. Lower purchase price on an established property, potentially lower mortgage costs. Higher rent, but your cash flow might be lower because your mortgage costs are higher, right? So, and with the established property, potentially a lower rent, but you might get a bit better cash flow because you don't have as high a mortgage on that property. If it's new and you're buying in like a house land package or housing estates or off the plan, again, as I mentioned before, potentially more supply will potentially mean slower growth. In established areas where there's not vacant land, there's potentially less supply and you may see faster growth out of those properties. Very limited add value potential with a new property. Everything is new, so you can't upgrade anything because it's all new. So you're really just relying on the market growth. Whereas with an established property, you've got better add value potential. You can do a renovation, some form of renovation, anything from just some new paint and new carpet to putting in a new kitchen or whatever it is, or doing extensions or even development, subdivide the back block off or something like that. So a bit more potential with those. New estates typically are further away from the city because they need lots of land and the vacant land is further away from the city. So established suburbs are typically closer to the city. So you might find that people don't want to have that further commute. Depends on affordability, right? Smaller blocks of land. So these days, obviously, what they do is they tend to build their houses on smaller parcels of land, whereas back in the 70s or 80s, they used to be a decent size. The old quarter acre block, extremely rare these days, unless you're buying acreage, I guess. But in suburbia, in new estates, probably not so much. It also takes several years to see the resale value. So when people, buy a new property, they don't buy it today and sell it, in a year's time. Typically, they'll hold on to it for, probably a minimum of 3 to 5 years before they would, look at selling it, which means it's hard to get the resale value. You don't really know what it's going to sell for until that time period ticks over and you start to see these properties come onto the market, onto the open market. So, when you buy it originally, you're paying the developer's price as opposed to a real market value, I guess. Whereas an established property, there's proven resale value. You can see, the house around the corner that's almost the same as this one. It sold just recently for this price, right? So you can see really what the resale values are because there's sales, lots of sales data in those established areas. Controversial maybe, but people say that, the build quality is not as good these days as what it once used to be. So purchasing an established property, you could potentially get something that's a better quality build. And there is construction risk as well, especially over the last few years where, we've been hearing in the media about, builders going broke and things like that because construction costs, increased and things like that. Obviously, if buying an established property, there's no construction involved, so there's no construction risk. So yeah, there are a few of those things as well to consider. So all of these things you should consider which one's right for you. So how should you buy a property, right? Be very clear on your criteria. What is it that you want, right? Know what your non-negotiables are, right? So a lot of people want 2 bathrooms, right? So a property must have 2 bathrooms, if that's a non-negotiable for you. Might need off-street parking or something like that. So you need to have a driveway or a garage that you can park your car in or whatever. And I know for me, for my home, not for investments necessarily, but off-street parking was a non-negotiable for me. And then, know your market. Become an area expert, as we call it. Go to the open homes, look at the condition of the properties, look what they're selling for, and really get to know your numbers, right? So you can make comparisons between, what it is you're looking at buying and what's recently sold and what condition was that in and what did it sell for. Also, talk to the agents in the area on a weekly basis. Tell them exactly what you're looking for and ring them up and say, hey, have you got anything, that suits this criteria? Talk to them, on a weekly basis, because then they know that you are serious about buying, and they'll want to help you out. Find out what properties are coming to the market. So, quite often an agent will know, oh, yep, we've been talking to someone, we're just waiting for contracts and things like that. So they know that they've potentially got something coming, which they can give you a heads up about. So if you can find out about those before they actually come to market, you're ahead of the rest. And try to inspect them and secure the property before it goes to market. So, the agent might, get a property, and then, it takes them a couple of days to get the marketing up and going. But if you're talking to them on a regular basis, they might say, yep, look, we've got one today. The marketing hasn't been done yet. It takes some time to, get the photos and everything done and then get it up onto whatever real estate platform they want. If you can get in and inspect it before that, and then potentially make an offer before that or before an open home, because once it goes to open home, people come in, they see it, you've now potentially got more competition, right? And that's potentially going to push price up. So, if you can try and inspect it, put in offers or try and secure the property before it goes to market, is a good opportunity. Or you can get Suburbanite to do it all for you. So that's pretty much it for tonight. You can get in touch with me. There's my phone number and email address. The green QR code gives you all my contact details. The blue one sends you to my LinkedIn page, so you can connect with me on LinkedIn if you like. That's pretty much it. Thank you everyone for coming. Happy to stay on for questions. And so I've got one there from Frank. What about properties available in holiday complex? Holiday complex letting, yeah, and it's the same with like Airbnb. Look, I think you can make some money out of it. I've not really done it. I prefer more of a steady, reliable flow of rental income rather than a really, up, down. Obviously, during holiday periods, it's up. During other periods, it's down. And obviously it depends where it is. If it's in the snow, and you do get holiday rental down there during the summer because now they do a lot of hiking and bike trails. But and then obviously beachside suburbs will get a lot during the summer and things like that. So it tends to be a bit for me anyway. The income or the rental income seems to be a bit up and down. I'd prefer something that was a little more consistent, just because it gives you surety around, what your costs are going to be and things like that. So yeah, so that's my thoughts on it. But yeah, I know people do it and they make quite a bit of money out of it. Um, and I've seen Nat, who's a broker there, has just put in banks don't love holiday income either. Yeah, they want to see something that's a little bit more consistent. Yeah, so yeah. So what else we got there? No, that's it. Cool. All right. Thanks again very much for joining me. Really appreciate you taking the time out. I hope you found it beneficial and you got something from it. And yeah, like I said, if you've got any other questions or anything, feel free to reach out. And yeah, I hope to catch up with you again on another webinar sometime.